Hi there. So in this video, I'd like to talk to you about the income statement. Now, this is not an accounting class. This is more of a finance perspective, which means that my objective here is not to go deep into the individual line items on the income statement. Rather, I'm going to give you an overall sense for what the income statement is about. And then also highlight some of the things that, especially as a finance guy, you should be careful of when you are looking at an income statement. So look, what is the income statement? At the end of the day, it's basically telling you what was your income, what was your profit. And profit is basically revenues minus expenses. So put very simply, the income statement is trying to tell you where did the money come from, how did you earn money, and then what were some of the expenses that you incurred in order to earn all of that money, and so what was left in the end. Plain and simple. Okay. That said, there are two things at least that you should be careful of when you're looking at the income statement. Number one, not all profit measures are created equal. There are different ways in which you can measure earnings. Every time I say income statement, my students tend to say, oh, net income. Yeah, okay, that's fine. Net income is one way of measuring earnings. It's the bottom line. It's the number at the very bottom. But there are other less finer cuts of profits that you may be interested in, depending on what your perspective is. If you are an investor, if you're somebody who's interested in buying the stock of a company, the measure of earnings you may be interested in could be different. If you're about to lend money to the business, then the measure of earnings you might be interested in might be different. So there are different measures. You should know what number stands at. Okay, so that's number one. Point number two, even more important, profits and cash flow are not the same thing. Right? So the income statement tells you profits, it tells you earnings, but that is not necessarily representative of the cash flow position of the company. You could be a very, very profitable company and yet have zero cash to show for it. And that's the other point that I'm going to try and emphasize. When you're looking at the income statement, don't think, oh, this is a profitable company, I should invest in it. That's not a good philosophy for investing per se. You should also pay attention to cash flow. So this lecture is not about how you can measure cash flow. This is more about what are some of the reasons, what are some of the things that can lead profit and cash flow to be different. And later on we'll talk about how we can make those adjustments to get a measure of cash flow. That's a different lecture altogether. So these are the 2 points that I'm going to try to emphasize. So with that said, take a look at a typical income statement. A typical income statement will start with operating revenue, the revenue that you earned from your operations. You'll have some costs. So the typical costs that you will see right off the bat are cost of goods sold and SG&A, selling, general, and administrative. So this is, utilities, wages, all that. These are operating costs. So I'll say these are operating costs. So operating costs. So these are costs that you had to incur in order to get your operations going, which resulted in this operating revenue. Now, right below this, you'll typically see depreciation. First of all, depreciation is also an operating cost. It is also an operating cost. Why? Because when you are running your operations, right, that is when your fixed assets are getting used up. And because they're getting used up, they're depreciating. So depreciation results because of operation, which means that it is an operating expense. That said, depreciation is what we refer to as a non-cash expense. It is an operating expense, but it is a non-cash expense. What does that mean? This is very, very important. Non-cash expense. No cash actually leaves the business. When it says that your depreciation expense was 90 million, all this means is that your assets depreciated by 90 million, but that doesn't mean that 90 million is actually leaving the business. This is kind of important. Why is that? Let me give you a very simple example. Let's suppose that you bought a truck for, let's suppose, $40,000. You bought a truck for $40,000, and this is the money that you paid. Now, the truck has a useful life of, say, 4 years. And you're like, you know what? Because I'm going to use the truck for the next, 4 years, I'm going to depreciate it equally. So this means that I'm depreciating it by 10,000 this year, 10,000 this year, 10,000 this year, 10,000 year. That's straight line depreciation, if you will. Okay. First of all, recognize, why are you doing this? the mere reason why you're recognizing this depreciation expense, because in accounting you have something called the matching principle. What does the matching principle say? The matching principle says that the expenses that you are incurring at a particular point in time should be matched with the revenues that you earned for that time period. So what is depreciation? Depreciation is your way of recognizing that, look, I paid all this $40,000 for the truck right around here, but I'm not using the entire truck right now. I'm going to use it over the next 4 years, which means I'm going to use part of the truck, or maybe 1/4 of the truck in year 1, another 1/4 in year 2, which means that off the $40,000, maybe $10,000, I'm using $10,000 worth of the truck in year 1. So this is the expense that I am incurring from using the truck in this year. It should be matched with the revenues that this truck helped me earn. Depreciation is just your way of implementing the matching principle. It's your way of saying that this is the amount of the truck that I'm using this year, and this is what the revenue this truck helped me earn. But recognize that at the end of the day, all the $40,000 that you paid for the truck left your pocket right around here. This is just your way of matching that $40,000 across different points in time, which is why we say that even though this is an expense, it's a non-cash expense. All cash left here, you're just matching it. So this is very, very important. Depreciation is an example of a non-cash expense. And this is perhaps one of the reasons why when you arrive at a measure of profits, you can probably now see that your profits, right, especially net income, you might say, oh, then maybe my cash flow position is somewhat higher because this 90 million, never really left my pocket. And you'd be right. And in fact, that's one of the reasons why profit is not the same thing as cash, right? So again, be careful. There are some non-cash expenses like depreciation, which can cause profit and cash to be two different things. Okay. My main point is this. When you have your operating revenue and then you subtract out all these operating costs, both cash and non-cash costs, you arrive at a number called earnings before interest and taxes. So this EBIT number is very, very important. In finance, you'll see this all the time. EBIT, what's the EBIT? Basically, it's a measure of profitability where you haven't yet netted out any other costs like interest expense, which is, it's an expense, and also taxes, because that's also something that you have to pay. So this is what you're left with before you have accounted for that. Then comes your interest expense. Now, you might ask, well, why not just dump it all together? This is an expense as well. Why do we have to look at earnings before that separately? Well, because this is more of a financing expense. This is a financing expense. This is an expense that is not resulting directly from your operations. It's a financing expense. The main difference is that while operating costs are, as a result of the operation, for example, you may not have direct control over them. What I mean by that is, if you want to sell, $10,000 worth of shoes, there are cost of goods sold that you're going to have to bear, all the raw material, everything that goes into a shoe. That's something that results naturally because of the operations. But interest expense is more of a choice in the sense that you chose to fund those operations using debt. If you had equity, then you wouldn't have had any interest expense. You would have had no debt. So interest expense is a financing expense, and it's more of a choice. So we account for that separately. Why? Especially if you're a lender, especially if you're someone who's about to lend money to a business, you're not as interested in the net income, but more interested in the earnings before interest and taxes, because you're like, okay, how much do you earn before you have to pay your interest expense, because the amount of money that I want to lend you is going to be a function of how much you will be earning before, right, this expense is incurred, so that I don't want this number to be too high in relation to what you earned right before, right? So as a lender, you might be interested more in this than the net income. So again, this is why it's important for you as a finance guy to be familiar with these different measures of earnings. So EBIT is one. net income is the other. Once you net out the interest expense, then you have your taxable income. This is what you're going to be paying your taxes on. Again, taxes can be of two types. I don't want to go into too much depth here, but there are taxes that you pay right away. These are current taxes, but sometimes, again, for reasons that I'll maybe talk about in another video, you can have some taxes which are deferred. Deferred in the sense that you're not paying them right away, but it is an expense because you have to pay them at some point. So these are expenses, but these are non-cash expenses in the sense that no cash has actually left the business yet. It will at some point, but you are recognizing that as an expense right now. Again, there are reasons for it. Don't want to go into that right now. So then you get your net income. So again, I want to emphasize two things. Again, going back to the points that I made earlier. There are different ways to measure profits, and profits and cash flow are two different things. What are the different ways to measure profits? I showed you two. One measure of profitability is EBIT. This is just looking at operating revenue, operating expenses. But then after you account for interest expense and taxable income and actually taxes, you get your net income. Sometimes you'll hear the term EBITDA. EBITDA. What is EBITDA? Earnings before interest and taxes you just saw, but also before depreciation and amortization, which means that you look at just this portion, subtract cost of goods sold and SG&A, and look at what you get in the end, right after this, before even depreciation. Why, you may ask? Why? Well, because of the different nature of depreciation. Remember, depreciation is a non-cash expense, and so some people say, wait, you're subtracting depreciation of 90, but no cash actually left the business, right? So if you want a better measure of what the cash earnings of the business are from its operation, maybe you should look at EBITDA rather than EBIT, right? And so again, we'll talk about who pays more attention to EBITDA versus who pays more attention to EBIT versus net income. That comes later, but my point is these are these different measures, and you should be familiar with all of these. So the last thing that I want to mention here is this. We just saw that profit and cash can be two different things. For example, you just saw that if there are expenses, non-cash expenses like depreciation, what that means is that your actual cash position can be different, in fact higher compared to the profit number. Sometimes it can go the other way. So for example, take a look at this $86 million worth of net income. So you might say this is a very profitable company, which is true. But let's suppose that all this revenue, this $2.2 billion worth of revenue, let's suppose that when you actually made these sales to your customer said, thank you for all these goods. I will pay you for these, but not right now. I'm waiting for some source of funding, so I'll pay you later. Now in accounting, you have something called the recognition principle. The recognition principle essentially says that, look, if you've made the sale, the final goods and services have been delivered to your end customer, then technically you can recognize all of that as revenue. So all of this entire number will show up as revenue on your income statement. You've earned it. However, you have zero cash to show for it because your customer just told you that he or she is going to pay you, 30 or 60 days later. So all this number is really doing is that on the balance sheet, it's just resulting in a high account receivable number as well, right? You have an asset, you have a short-term asset, but right now you don't have any cash to show for all this profit. And so my point is this: if you're exclusively looking at net income, you are not looking at cash flow. And again, what is the point that we've made earlier? Ultimately, you care more about the cash flow rather than profitability. So again, I'll mention this. Don't exclusively focus on profit, regardless of which measure you're looking at. Some measures are better indicators of the cash flow position of the company, but they capture certain things. They don't capture certain things. In future lectures, we'll talk about the different ways in which we can measure cash flow. But when you're looking at an income statement and you're looking at all these different measures of profit, know that there are different ways in which you can measure profit, and secondly, the reasons why profit is not an accurate way of looking at cash. You have non-cash expenses, and you have something like recognition principle in the generally accepted accounting principles that can cause cash flow to be different from profit.